Happy October. Are those real estate numbers scaring you yet? Or are you waiting for my market update to give you maybe some good news? Today we have a nightmare on Elm Street, how the Fed breaks the real estate market, and a little history on Elm Street. Actually, Carlsbad used to have an Elm Street, which is now Carlsbad Village Drive. So let's take a look at stats, graphs, and numbers, and it's always no fortune telling, only fortune building and helping you making wise investment decisions. Let's dive in.
That we're all glued to the TV and waiting for the next Fed meeting and what the interest rates are going to be, as if interest rates rise, definitely the affordability is become a problem. The Fed is the market. Clearly, the Fed shift in word choice from June's housing needs a reset to the latest housing reset actually means a correction indicates that the Fed is actually fine with home prices falling, home sales cooling off, and construction pulling back. Even Zillow realizes that it might be a good idea to get out of the fix and flip business. Or do they know that we are maybe in a bubble and that home prices will decline or even crash? And I say will. We actually will see later which markets already have seen a decline. And is San Diego one of those? Also, John Burns, kind of thermometer or signs of a market bubble, has 10 markers, which pretty much all of those are flashing red at the moment. Like everybody has multiple homes, there are outlandish parties and euphoria, there is falling builder stock prices, falling sales, obviously waning demand, and very poor affordability. I believe the only green one is still that we do not see any creative mortgages so far. So we also have no mortgage default or even ARMs, but everything else does show the signs of a bubble, according to John Burns. Now, how do we know we are in a bubble or correcting? The Redfin definitely says, hey, we have practically 8% of all listings at price drops. I think we have more as listings are being relisted at a lower price and refreshed because definitely listings are sitting longer on the market. And how much is too much? Why we see falling demand? Historically, an average house in the US cost around 5 times the yearly household income. So during the housing bubble of 2006, the ratio exceeded 7. In other words, an average single-family house in the United States cost more than 7 times the US median annual household income. And as we can see, we're currently an average at 8. In San Diego, it is 10. We kind of have a double whammy if you're looking at the affordability because higher mortgage rates are responsible for about half of the increase in median price home payments. But the other part is that prices have been still climbing, even so the interest rate have been going up from 3 to about 7%, and that's exactly what the Fed wants, that affordability is falling. The mandate of the Fed is really price stability and low unemployment. How are they doing on the unemployment? You would think, yes, we have the lowest unemployment in also 50 years, but the numbers are skewed because all the latest layoffs in the tech industry, mortgage companies, and banking sector, guess what? They don't show up in the unemployment rate. They're getting severance pays and nice retirement packages. So let's see what other people think if the inflation is going to come down, or does it keep going up, because then the Fed has to raise interest rates even higher.
The economy is going to perform into the future, and this is the Fed's intention, right? This is what the Fed wants to combat inflation. But I think the question to ask is inflation really going to continue over the next 6 to 12 months? And there's varying opinions on this, but my opinion is we're seeing deflationary pressure in the U.S. economy right now, particularly through the housing market. Home prices are going down, but maybe even more importantly, rents are starting to go down. And the cost of rent, that's roughly 1/3 of the inflation calculation. And so if rents continue to go down, that is going to bring down inflation. And that is starting to occur as the Fed is aggressively hiking interest rates. And ultimately, my prediction is that this is going to end in a deflationary crash. I've talked on this channel before about what happened.
And if you're wondering what channel it is RE Consulting, and this is Nick. I would suggest you follow him. He has some great videos. So let's actually see what happened in San Diego in September. So we have a median home price of $792,000, which is up 6%. But remember, we have been seeing appreciation in the 15-20% range. So as you guys can see, prices have been going down dramatically in the last 3 months, from actually $870,000 about at the peak. The medium detached is at $910, and the medium attached is about $600. And we also see an average price per square foot still up around $568, where if you're looking about a decade ago, it was $240 a square foot. So right now at the end, we don't have the final number in, but right now the median home price is still hovering around $780, so which means it has leveled off last month. Okay, the days on market certainly have increased by nearly 50%, and as everybody knows, the sales volume is down, pendings are down, and we actually see a 1.6 months of inventory, which is up. But what we do see unseasonally high is actually inventory. Usually the inventory drops in October, but it has been, let's put it this way, inching up. So we currently have about 4,600 units listed on the MLS. So where we can see too what the market has trouble with increasing the appreciation is that we see the average price the property sells off the original price. And in April 22, where everybody was high on the house drug, we had 106% or nearly 107. So now we're actually below 98, and I think it's like closer to 96. So lots of price reduction. Is it the dip, or are we going to see a further price decline? We might also watch how many houses are still selling above list price. So I take let's say a busy closing day like a Friday or a Wednesday, and I look how many houses of that day are still selling above list price. And currently we still see 15%. So there is certain demand for certain houses out there. But let's see what Barry Habib thinks about, because he has a little bit of a contrarian view to will we see a price drop or price crash.
Here's the good news. Starting with the October 22 report, which we'll be receiving November 10th. That is going to begin a string of reports that will be replacing much higher numbers here, as you could see. As we go into the fourth quarter of 2022, we will be replacing fourth quarter 2021, and even in the first half of 2023, as we replace these 2022 numbers, which are higher readings, we have a really good chance to see inflation decline, and decline by a significant amount. And as that happens, long-term rates, like mortgage rates, will then probably follow suit, just like they always have. I mean, you can see here, this is just a cute thing about, our Fed chair not understanding inflation, but we can see here the bottom line being the rate of inflation and this upper line being mortgage rates. Now, whether it be mortgage rates or any kind of long-term bond, that's going to be driven by inflation. So when we see inflation go up, mortgage rates go up. Inflation comes down, mortgage rates come down, and so on. It didn't follow that pattern. It was broken with quantitative easing. Once the Fed fixed the game and rigged the game, they were buying enough mortgage-backed securities and treasuries to keep yields very low. And as you can see here, the Fed did a good job, whether you want to call it a good thing or not, but they did a good job of keeping mortgage rates roughly at 3% for the QE period. But meanwhile, inflation was moving up at a pretty significant pace. Normally, mortgage rates would have gone up, but the Fed rigged the system. Notice once they took the guardrails off and let the market behave freely, mortgage rates did what they always do, move with inflation. So as inflation went up, mortgage rates went up. Inflation dipped, mortgage rates dipped. Inflation up, mortgage rates up, and so on. So as you can see, we're in a situation where as inflation goes, so will mortgage rates go. Now, there are other factors, of course, but the main driver will be inflation. And we believe that there's reason to feel pretty darn good that because of the Fed rate hikes, maybe slowing things down too much, whatever, okay, but also we are hearing reports that the economy is showing some signs of slowing down. We know that people are having other alternatives to put money to save it instead of spend it. I mean, look at your 6-month treasury at 4%, probably go to 4.5% with the next Fed rate hike, or certainly on December 14th with the subsequent Fed rate hike. You may be somewhere close to 5%. That's going to be tempting. And remember, no state income tax on those. So that's going to be a tempting risk-free return, essentially. So people, instead of spending it, will save. And then it's much more expensive, of course, on those variable products like the consumer industrial loans.
So you can see the entire interview on Malden Economics, and I would suggest you do, because he believes once mortgage rates going back down and still with our historically low inventory, we will not see a further price decline. But what do we always say? We always say every house needs a willing and able buyer. So here we go with the willingness, because Fannie Mae's HPSI, which is an index about how the consumer feels about housing, took another 1.2 point decline in September and is one of the lowest ever on record. So only 19% of consumers actually believe it's a good time to buy a home. And please let me know if you are one of those 19%. I do see deals practically every week. Also, if you like to buy properties that you can convert part of the house into an ADU or add an ADU, that is still a good investment strategy. And if you believe in Barry Habib's opinion, maybe, this is the dip where you should buy and maybe then otherwise refinance. So we can see the inventory is building because new home sales are down 11%. New home inventory is right now at 9 months, so the highest since actually 2010. Remember, we need the interest rates the inventory, and what else is important for what drives real estate prices? So what about household formation? In terms of household growth, there are several reasons to expect that household growth has slowed sharply since the beginning of this year. In fact, there's a dynamic shift right now between household growth and housing production, aka inventory, as we noticed that the inventory for detached homes is higher, the new homes inventory is higher, but we also will get a lot of units online in the multifamily market. And we have really an unprecedented surge in mortgage rates this year, and which would also suggest a decline in home prices, at least maybe through the middle of next year. So you take the unprecedented increase in rents, which from late 2020 to the middle of this year, and we're seeing the increase in inventory in rental units. So that would actually suggest that we will see a decline in rents next year, would be a reasonable base case.
The takeaway for October's market update, medium home price is down, but currently leveling off in San Diego. Interest rates hit 7%. Inventory is up and building where it's supposed to decline in the winter months. Buyer demand is down for existing homes as well as for new homes. We have started seeing declining in rents and black swan hunting. What do I mean by this? There is a lot going on around the world, from pension crisis, currency crisis. Governments seem to not stay long in business in England, and we might see the Ukraine war getting worse. We have to deal with China, with Taiwan, and still very high inflation. If it keeps going, it should have a pretty effect on the housing market. And the housing market matters because the housing market is about 20% of GDP. So be careful in what you invest in. Put a little safety margin into your portfolio and invest wisely.
Or if you want to get more educated, join us on one of our field trips we have been doing over 14 years, exploring investment opportunities and running the numbers for maximum profit. You can find me on Meetup under Real Estate Investing Field Trip. Market update gave you some answers to the questions. Should you have more, you have my number. Happy to talk to you. Thank you for listening and thanks for being fans. Don't forget to like and subscribe.